How's it going, everyone? It's Sam. Today we're doing the next installment of my weekly dividend series where I talk to you about what I'm buying each week, and I'm investing $100 a week. So I'm not alone in doing this. I'm doing it with two other YouTubers. One is Logan Fisher and the other is JT Wealth. They're also investing a set amount each week, and I'll include their links down below if you want to see what they're buying. They're both partners of mine, and I really like being able to work with them and to talk about different stock ideas and different options. And it's cool just to see our portfolios grow each week. So if you want to join me in this journey, you can use the link down below to M1 Finance. That's the broker or the company that I'm using each week to invest through. I really like them. I have a review video that I'll show here if you want to take a look at M1 Finance and why I really like it. I talk about some of the pluses and some of the minuses. So definitely check that out after the video. But today we are investing another $100. I'm really excited too because we're going to do the first portfolio review. So I'm doing this with one of my Patreon members, Fernando. So if you want to join our Patreon, we are going to do regular review videos. I can only review so many portfolios. So if you want to get on that list, I think we have 3 or 4 people signed up already to have their portfolios reviewed, but we'll be doing one a week. So if you want to join our Patreon, I'll definitely take a look at your portfolio. But it's going to be interesting because we go over what you're trying to do in your life and then talk about the investment options that you're making and the investment decisions you're making and whether you should be able to hit those. Now, no, I'm not a financial advisor. I'm not a professional. This is just one person's opinion that's a finance YouTuber. So just keep that in mind. I definitely can't tell you what to do. I'm just telling you my thoughts if I was you and in your situation. So let's take a look at the dividend and income portfolio here. So again, we're investing $100 a week. Hopefully by the time that I'm 60, this should be able to grow to about $1 million. Right now, it's at $838.63. We've seen some nice gains overall, and we have a return of about 10%. So this is adjusted for time. So we've seen a market gain of about $39. As we can look here, you can see all my different portfolio positions. I'll show you what I bought this week, but we have 8 positions. I'm trying to keep it between 8 and 10, so we might be adding a lot to our positions in the future. Now, if we look at the actual activity, what happened this week, we bought 3 different stocks. We bought Jpmorgan Chase, just a small $10 amount. So I'm pretty bullish on the bank stocks. They're massive companies that have, I think, a lot of upside potential. Jpmorgan Chase is still down between 30 and 40%, I believe. And they are just a great opportunity, great company that's just massive, really important for the U.S. economy. They're basically backed by the U.S. government, and they do pay a nice dividend. They are one of my largest holdings, if not my largest holding in the portfolio. I also added $50 more of Disney, so I talked about Disney last week, and I am buying them when they're still about $128. So I've bought them before when they were only $90-ish in some of my other portfolios. So I have a cost basis that's much higher in this portfolio, but they're adding so many new subscribers to their streaming platform. This is going to be something that I think will be highly profitable for them in the future. And it's not as capital intensive as some of the other parts of their business. So I think it's going to be really important for their business going forward to be able to scale this. And then once it's at large scale, then they can hike up the prices a little bit and make a lot more profit on their streaming subscriptions. The next company that I bought was Foot Locker. So I haven't gone into much detail about Jpmorgan Chase or Disney. They're both companies that I've gone into before. I've talked about them in previous videos, but I'm going to take a little bit of a look at Foot Locker here. And I realize that this is a company that other YouTubers have talked about, but just because other people are talking about it doesn't mean that's not a good option. I own this in some of my other portfolios. It's up about 6% on the day also. And they have a market cap of just under $3 billion. They own Champs, and they also own Eastbay, so it's not just the Foot Locker brand, but a market cap of about $2.9 billion. If we go over to their financials, they are really a cash cow company. Now, they've had a little bit of a rough time due to the pandemic because a lot of their stores had to be shut down, but a lot of them are reopened or are reopening now. Their revenues are right around $7 to $8 billion a year. And again, this is a small market cap company, but the exciting thing is their net income is very high. So over the last 2 years, it's been floating around 500 to 550 billion. That puts them at a PE ratio between 5 and 6. That is really good. I mean, they definitely have not reported the same numbers this year, but I think after they're able to get back to profitability, I think they're going to have a massive cash cow business. Now, the other thing that's exciting about them too is their balance sheet. So again, $2.9 billion market cap, but about half that market cap is in cash. So they've been able to fall back on some cash and be able to ride out this storm because they have about 1.37 billion in cash. That is a massive amount. And for the company to still be able to produce net income as high as they've produced it in the past and to have all this cash sitting around, that's awesome. I think that this is going to really help them in the future months if there is some kind of shutdown again, which I don't think there will be. But if there is, they're going to be able to ride this out really well because of all this cash that's sitting around. They did bring back their dividend recently, so they did announce a small dividend of 15 cents a share. Now, this is on a quarterly basis, so overall, it's still about 2% yield. They were much higher than this before, but I think as they get more money and as they become more profitable, it will continue to rise. They're still down about 25% from where they were pre-pandemic, even a little bit more than that. So I think there's still a lot of room for it to get back to where it was and to become profitable again and really pay out their shareholders with dividends. So I'm excited to invest in them. Again, it's not a massive part of my portfolio, but it is something that I'm going to be hopefully adding to in the future. So you can see all my different positions here. Jpmorgan's my largest, Realty Income, AT&T, Disney, IIPR, which is one of my biggest and best returns so far, up about 24% just in the few weeks that we've been doing this. And right now, it's good. Everything is up. Everything is profitable. It's an awesome time to be an investor. So I get that when you see something like this, you might think, okay, there's a bubble or it can't just keep going up. But that is a dangerous way to be thinking, because if you continue to think like that, then you might not ever jump in, or you might jump in way too late, because it's really easy to see the numbers right now and the stocks are up and think that they can't go any higher. But if the stock market keeps growing like it's supposed to, 7 to 10% a year, most of the time you're at all-time highs or close to it. So definitely take that into account. Don't hold on too long before you start investing. I'm a firm believer that it's better to dip your toes in and start investing than hold out and wait for another huge crash that typically doesn't work well for people. But do your own due diligence, do your own research on it. Again, I'm not a financial advisor, so take everything I say with a little bit of a grain of salt. So let's get into the portfolio review. So Fernando, one of my patrons, was nice enough to let me review his portfolio, and I'm going to show the messages that he sent me and give you a little bit of a background on him before we look at his portfolio. He says, I'm 35, 3 kids. We arrived in the U.S. in November 2018. I'm working in the IT department in an accounting firm, making around $20 an hour. Learning about stocks on the weekends. I live in Katy, Texas. I'm from Venezuela, so I'm really bullish on oil. There is a big oil company, Venezuela, called PDVSA, and if the oil prices are good, profits are exponential. There was an oil crisis late 80s to late 90s. I think it is happening again, and oil will always come back. So that is why I have so many oil stocks. Also, I'm new in the market, so I'm learning how to invest. My wife also has money in stock. That is why you shall see Robinhood 1 and 2, WeBull 1 and 2. I don't feel safe buying just a couple stocks because I'm not 100% sure of what I'm doing. This is why I have so many. But I would like to have fewer companies. I'm bullish on restaurants too. The last stock I buy was Dropbox, but just because Jeremy recommended, that guy has been doing good plays and I'm pretty sure that he knows more than me. My goal for this year is to have more than 10K in stocks. Next year, I need to save money if I want to buy a house, so I wanted to have some cash flow in the stock. That is why I have some odd plays like CJJD, NERV, GBLS. Now I'm bag holding these stocks, so I think I could be able to make some short-term gains. I just need to do it better, but I feel good doing long-term investments. I would like to have $100,000 in the stock market in 5 to 8 years. More will be better, LOL. If you have any question about the portfolio, my portfolio, let me know. I included my average price. And then I also asked him a little bit more. So he says he's putting 4% of his paycheck into his 401k and the company matches 4% more. He also makes regular deposits, 10% of almost every paycheck. He has no debt, but he would like to save the money for a house. He would also like to learn how to make money in the market, maybe cover calls or options, not sure. He has to learn about it. He tried swing trading, holding the stocks for a few days and then selling it, but he didn't have it work all the time for him. So let's just talk about this for a minute before we look at his portfolio. He's 35, has 3 kids. I think that's great that he's starting to invest. He wants about $10,000 by the end of this year, and he wants to be able to grow this to $100,000 in the next 5 to 8 years. So it's great that he's starting to invest. He is pretty bullish on oil, and I understand that as someone that's coming from a country where oil is the main product coming out of the country, and it's a huge part of the culture. I understand that here in the US, we could probably equate that to something like technology or the tech sector. That's just a massive part of our economy, a massive part of our daily life. So I get that. He also is getting the 401k match, which is awesome. I think that's really important. And he's also investing 10% on top of that. I'm not sure if he's also able to save money to buy a house or if he's going to have to stop investing to save money for that house, but that wasn't super clear. But either way, if he's depositing 10%, that's awesome, especially if he can buy that house and stop renting and build up some equity in another way. That's awesome. So let's take a look at his portfolio. So there are 4 different portfolios here. There are a lot of different stocks in here, so I'm not going to go through every holding. I'm just going to hit on some of the highlights and tell you my ideas and my thoughts on the portfolios in general. So this one has about $880 worth of cash. It has about $4,000 overall in the portfolio. If we take a look here, BP, oil, Exxon, CCL, Oxy. As we go down, you can see Play stock, SPY, SPG, which is a REIT that I also own. It's a little bit riskier right now, but probably a good long-term play. Cirrus Logic. So you can see all the cost basis on here too. If we go into the next portfolio, we have about $1,400 in cash, so that's a large cash position in these portfolios. I'm guessing Fernando is just depositing money and then buying as he sees fit. He's not just investing right away when he throws money in there, or maybe it's because he's buying and selling a little bit. But you can see bank stock here, about $1,000 in DBX, which is Dropbox. We also have some Berkshire in here and some Win. So 3 companies that Jeremy from Financial Education has talked about a good amount. I think that he's talked about each of those 3 in separate videos over the last couple months. In the third portfolio, Robinhood, we have MRO, which is Marathon. We also have CNK. We also have Wells Fargo. So we also have some CCL and some other plays in there too. Some of the same that we had in some of those earlier portfolios. And then in here we have a couple other stocks, Restaurant, Cinemark. So overall, without going into every position, there are too many positions here. I understand what you're saying, that you have lots of positions. I feel like I have too many also. I have maybe 20 to 25 right now. But right here, it looks like there are maybe 30, maybe a little bit more than 30 positions. I would try to cut those down, like you said. I think that that's a good idea. I know it's hard because some of these you're bag holding on. Some of these are good long-term positions, but you just want to have some in less positions. It's hard to keep track of all these different stocks. However, I would say that this is really focused on oil and some of the other riskier investments like restaurants, like CCL. I think that those definitely have potential, but I would throw in some stocks that just do well over time, so that way you continue to grow and you're investing in some of the larger companies. I notice here that there isn't a lot of big name tech. This might just be because you enjoy investing in companies that make good amounts of money, and the tech industry is more expensive compared to something like oil. But I also think you have to realize that these are companies that are going to be able to grow. They are going to be able to branch out in a ton of different industries. I would also say too, I would be careful about investing in oil too much because overall the oil industry is declining. There are tons of alternatives that are popping up. A lot of companies that are going to be able to provide cheaper, more efficient, greener options than using oil. So I personally am not really investing in oil. I think that if it's just a turnaround play, it can make sense. But as a long-term investment option, I think that oil will be used, but it will decline a lot over the next 10, 20, 30 years. So I'd be careful about that about investing in that too much. The other thing that I want to hit on too is the fact that you mentioned some of these you're investing just because Jeremy from Financial Education has talked about it. I know this happens a lot with his channel where he has 600,000 subscribers. There are a lot of subscribers that don't have enough time to do their own research. So a lot of people end up investing without really looking into the stocks. I'd be careful of this because just like anyone else, Jeremy can have it wrong. So if you invest $1,000 in some company, while it might do well, and I think Jeremy is a good investor, he could be wrong. If he misquotes something or the company goes down, that is your money that you're losing. So I'd be careful of that. I don't think that getting his information and then going and looking it up on your own time is a bad idea. That's kind of what I do. So I listen to a bunch of different YouTubers, just like you might listen to the news or check the newspaper. You need your news from somewhere, and then you do your own due diligence on top of that to make sure what they're saying is correct, clarifying what your thoughts are on the company, where you think the company is going to go in the future. So definitely try to do your own research. I think it's a little bit risky. If you're looking over a long-term span, it's risky to invest without having your own due diligence and checking in on the companies yourself. Now, going on to what you were saying that you wanted to hit $10,000 by the end of the year, I think you're right around $10,000 when we look $4,000 plus $3,000, so $7,000 essentially, and then $9,600, and then the WeBull account, so over $10,000 now, and you want $100,000 in the next 5 to 8 years. So based on how much you said you're investing, 10% of your income, if you're making $20 an hour, that's about $4,000 or so. And then you're getting the company match of your 4%. So that's about another $3,200 to $3,500, depending on, any bonuses that you might get. But you're investing right around $7,500 a year. I think that's a good amount. That's more than most people invest, and more than most people invest that make even a lot more money than you do. So I think $7,500 a year is a great starting point. If you can invest that on top of saving it for a house, I think you're going to be very close to your goal. So if we look and you just average a 7% return, which is very doable, that's about what the stock market gets just in the index funds, you would have a balance around $94,000 in 8 years. So if you bump this up a little bit, or if you have a little bit higher return, that's definitely doable. You said that you're 35, so this would be when you're 43. Let's look at when you're maybe 55, how much money you'd have. So 20 years from now, we're looking at about $345,000. If you're going until you're 60 and you're investing the same amount now, you have over $500,000. That's definitely a good point to be at. That gives you a lot of cushion if you're getting Social Security too, or if you're just continuing to work. Now, if you can bump this up or you get some salary increases, that's awesome too. So you're in a good situation going forward. I think that you're going to hit your goal, Fernando. So definitely keep on the same track. Try to diversify maybe a little bit more into some of the big tech. I really like them. But just in general, try to diversify. I think diversification is important. And maybe even just throwing in some index funds. So instead of having a lot of your money in all these different individual stocks, if you want diversification because you're worried about being diversified, but you also don't want to hold all these different companies, you can definitely invest in some different index funds to kind of get the best of both worlds. So thank you guys so much for watching. I appreciate it. I know this was a little bit of a new format. I'm trying to work out the kinks. So thank you guys so much for watching. I appreciate it. Let me know what you're buying this week and what your thoughts are on this. If you want to become one of the patrons that can get their portfolio reviewed, definitely use that link down below. Check it out. I appreciate it, and I will see you guys in the next video. Bye.